Hey everyone, Raul Shah, Doc Shah Financial, and in today's video, I'm going to show you how to invest in 2024. So the basic premise is pretty simple, but we're going to walk through a lot of different concepts and ideas, and I'm going to keep it very simple, and I'll try to use some humor too. We're going to have this video in 3 parts. The first part is understanding why you should invest and what you're losing if you don't invest. The second part is going to be how to actually invest. And then the third part is addressing some common questions that you might have or fears or misconceptions about investing that hopefully I'll answer in this video for you. So what's the basic idea behind investing? It's very simple. You are putting aside some money today because you want to make more money tomorrow. That's it. That's why you invest. If you were going to put aside money today and I told you you were going to have less tomorrow if you did that, well, then you would never do it, right? So you're making a sacrifice up front so that you can ultimately raise your standard of living in the future. Now, there are different investments that you can make that will sort of either expedite that process, slow down that process, or even deter that process, and we'll get into that more so in the second part. But really the main problem is this, and a lot of people face this in their daily lives. Let's say you make $1,000 this month, okay? And you take that $1,000 and you just put it in your pocket, or you put it on your mattress, and it never sees the light of day. Well, what's going to happen is that $1,000 that's worth $1,000 today, in 1 year is going to be worth like $950. It's still going to be $1,000, but it's only going to have $950 of purchasing power, or whatever inflation is over that period of time. And the same goes true for the next year. If you held that $1,000 that you originally had in year 1 for 1 year, you're at $950, and you hold it again, it'll only be worth maybe $905, and so on and so forth. This process will keep repeating. And so in 2 years, you're going to think, well, I had $1,000 2 years ago. Why can't I buy $1,000 of stuff anymore? And it's because that cash that was just sitting there was just getting eroded by inflation. And so you really need to invest, not just in order to keep up with inflation so that you maintain your purchasing power, but also so that you can exceed that and you can actually increase your standard of living. Because that's really the whole point of investing, is we want to take money that we have today and we want to make a heck of a lot more in the future. And I'm going to actually show you some of the best ways to do that. But first, let's talk about what are some of the not so good ways to do that. You've probably watched a bunch of other videos before landing on this one about people telling you to buy NFTs or day trade, or foreign trade in the foreign exchange market. All of these stuff are garbage strategy. You're not going to make money doing this. If you want to make real money, I'm talking raising your standard of living substantially, jumping levels, you need to value invest. You need to buy really good, high quality stocks, and you need to get them at dirt cheap prices. That is the way that you're going to make the best risk adjusted returns. Otherwise, you're just gambling. Options, futures, any sort of a derivative, foreign exchange, day trading, these are not going to make you money. And, just as a quick side note, the real irony with people who day trade is they'll buy a stock at 1 and they'll sell it at 2, and they'll buy it back at 4 and sell it at 6, and they'll call that success. And if you have to ask why that's a problem, well, then you probably shouldn't be investing, because what they basically did was they bought a stock at 1 and they missed out on just holding it and selling it at 6. Value investing is identifying what a stock is worth and then buying it below that value. Now, you don't have to worry about all that for now, but I just want to walk through some of the things that are not going to get you good results, and that's not what this video is going to be about. Historically, the best way to grow your net worth and increase your standard of living is through buying stock. Now, there's lots of different ways you can do this. You don't have to buy individual stocks. Of course, if you do buy individual stocks, you have a much greater odds at reaching that ultimate goal. But you can buy index funds, or you can buy ETFs, you can buy baskets of stocks. They don't typically go up as much because there's so many of them, right? If you have a basket that has 500 stocks in it, right, some are going to go up, some are going to go down. That overall basket is going to it's going to have gravity to it. It's not going to be able to really rise as fast. But stocks are a great way to increase your net worth. So what is a stock? Well, it's an ownership claim in a company. So if I buy stock in McDonald's or Apple or any other company, I am actually a part owner in that company. Now, I can't dictate, I'm not a manager. I can't tell, executives what to do unless I own, a very large amount of shares. But what being an owner means is that I'm entitled to McDonald's share of their profit. So if I own 1% of this company, well, then I'm entitled to 1% of the profit. And so we want to be owners in general. That's a great thing as a side note. But owning shares in companies are really great because now when the company is successful, well, then I get to partake in that success and I have a claim on all of the future earnings of that company. Now, a lot of people want to buy individual stocks that don't know how to value them. That's very tricky and you run into problems because if you don't know what something is worth, well, then how can you really determine if the market price is fair or not? And that's why, working with someone like me would be really great. I've been doing this for a long time. In fact, my track record as an analyst is public if you just Google Raul Shah stocks. But let's say you don't want my help. Hey, Raul, I don't need you. You suck. You're the worst. I hate you. Can't stand your face. Okay, that's fine. I mean, that hurts, but that's fine. You can buy index funds or ETFs, and it's very simple and straightforward. And as far as buying the actual ETFs or stocks, you just have to make an account with a brokerage firm. So you could use Charles Schwab, Fidelity, E-Trade, any of these big brokerage houses. And it's pretty straightforward. You just follow the instructions on the screen. They'll walk you through how to create an account. And then you can also just Google different index funds and see kind of what, makes sense for you. I can't give recommendations to anybody watching this because I don't know you personally, but you can do that. It's all pretty straightforward stuff. Okay, now let's address some common fears that a lot of new investors have. The number one is going to be fear of losing money. So how do you lose money in a stock? Well, generally speaking, it's typically if the asset's earnings are going down. So if I buy McDonald's and all of a sudden McDonald's is starting to post losses or they're making less money than they were the year before, all right, that's going to send the price down. Markets are forward looking. So when you buy a stock, all of the forward expectations, right, all the cash that this company is going to make is actually priced in to that current date stock price that you're looking when you check the stock quote. Now, if the expectations for the future go down, the stock price generally goes down. And if the expectations for the stock goes up, the stock price generally goes up. So the way you lose money is if you overpay for a stock. So if you're buying an individual stock and it's only worth $10, but you pay $20 for it, well then you're probably going to lose money over time. It may not happen overnight, but generally speaking, assets tend to always intersect at their fair value if you give it enough time. Now, the other way you could lose money is if you buy, let's say, an index fund or an ETF, and the overall market goes down. If there's a recession, typically a lot of these companies that are in these baskets will suffer, their earnings go down. It's really the same reason an individual stock price will go down. But then overall, that basket will lose a little bit of value until the market will recover. If you're going to buy stocks, whether that's individual or a basket of stocks, it's going to happen. You are going to have down years. You are going to lose a little bit of money. The real key is you have to be able to stomach volatility. You have to have a good temperament, a good disposition. That's actually the most important thing in investing, is being emotionally stable, being patient, and being disciplined. If you have those three traits, you'll likely be a really good investor. If you don't have those three traits, you'll probably really suffer, because the moment that something goes wrong, which it will, you're going to panic and then you're going to sell. And ultimately, that's how a lot of people lose money, is because they bought something really high, they overpaid, and the price crashed, they panic, and then they sell. That's very, very common. I really want to harp in a little bit on the fear of market volatility, because when people's portfolio goes up, they feel great. And then when it goes down, they feel terrible. And again, investing requires you to be very stable. And I'll just give you a little personal story here. I've had times where, maybe for 6 months or maybe 8 months, 9 months, where I've actually underperformed the market, where my stocks actually went down more than the overall market. But because I knew what I owned, I'd done a lot of research on this, I calculated what my businesses were worth, I didn't panic. I just basically said, okay, it'll take a little more time than I expected. And then ultimately, my stocks have gone up very, very nicely. And in fact, if you Google my track record, like I mentioned earlier in this video, you'll see that. As a private investor, I've been very successful, and I've been doing it buying individual stocks. Now, there's, like I said, a lot of nuances to that, but it's not that I possess some kind of superior intellect to the rest of people. It's just that I have a, very generally speaking, a pretty stable disposition, and I understand what I own, and that prevents me from panicking. Because if I was just gambling, like I mentioned at the start of the video, like buying options or futures or trading in the foreign exchange market, doing all these things that are just speculation, then I'd be panicking, right? I'd be buying high and selling low, just like everybody else, because I don't have any idea what I'm doing. And so understanding that market volatility is normal, that as long as you've done the research and you know what you own, you're going to be fine. Okay, so don't worry too much about that. Just, go out, enjoy your life, and you'll be okay. But do the research first. That's the most important thing. If you don't do the research, then you're in trouble. All right, guys, thanks so much for watching. If you want any help creating and managing a stock portfolio, I do that for clients all the time. I run an investment advisory firm. Actually, we're really a wealth management firm. I mean, we do everything holistically. So yeah, shoot me an email, Raul at Dockshot Financial, and I'll see you guys in the next video. Thanks for watching.